Somewhere right now, there's a video promising you can turn $10,000 into $500 a month in dividends starting today. Let's do that math together. $500 a month is $6,000 a year. $6,000 on a $10,000 account is a 60% annual yield. A reliable, sustainable, relatively low-risk 60% yield is not an investment plan. It's either extreme risk, a temporary anomaly, or a warning sign. So before I show you how this actually works, I need to show you the thing almost every one of these videos hides from you. Not the destination, the timeline. By the end of this video, you'll know exactly which portfolio gets you to $500 a month the fastest and how long it honestly takes. Let's start with real numbers. And I want to be precise here, because dividend yield isn't one single number. There's the 30-day SEC yield, which annualizes the last month of income, and there's the trailing distribution yield, which looks at what was actually paid out recently. They're close but not identical. Depending on which one you use, SCHD sits around 3.3%, JEPI sits around 8%, and JEPQ sits around 11%. Run $10,000 through each of those, and here's what you actually get paid today, this month. SCHD, about $27. JEPI, about $69. JEPQ, about $92. Not $500, $92 at the high end. So how does anyone get from $92 a month to $500? Two ways: more money upfront or time. This video is about time, starting small and building, which means the real question isn't whether this works. It does. The question is how long it honestly takes and what's the fastest realistic path. Here's the capital math. $500 a month is $6,000 a year. At a 3.3% yield, you need about $180,000 invested to produce that. At a blended 6% yield, you need around $100,000. At a blended 9.5% yield, you need roughly $63,000. 3 destinations, 3 different amounts of capital required to get the same monthly check. Now let's build the 3 portfolios, with actual allocations, not vague blends. Portfolio 1, conservative, 100% SCHD, yield around 3.3%. SCHD is built around established, profitable, dividend-growing companies, screened for quality rather than the highest number on the page. That makes it more resilient than a pure high-yield strategy, but it's still a stock ETF, and it can still drop significantly in a bad year. Don't mistake quality for safe. Portfolio 2, balanced, 50% SCHD, 50% JEPI. Blend the 2 current yields and you land around 5.8%. Call it 6. You're trading some long-term price growth for cash flow today. And here's something worth being precise about. JEPI isn't paying you purely from corporate dividends. A meaningful part of its income comes from selling options on top of its stock holdings. So, dividend is the keyword that gets this video found, but monthly distribution is the more accurate word for what's actually landing in your account. Portfolio 3, aggressive, 60% JEPI, 40% JEPQ. JP Morgan's own numbers on that kind of blend land around 9.5 to 9.9%. Same note applies, doubled. This income is a combination of stock dividends and options premium, concentrated in NASDAQ names for JEPQ specifically. Here's the part most videos skip, the timeline. And to make this a fair comparison, let's first hold the contribution constant, $300 a month, every month into each portfolio, reinvesting every distribution automatically. Isolating just the yield, here's what happens. The conservative portfolio growing toward its $180,000 target takes about 26 years. The balanced portfolio growing toward $100,000 takes about 14 years. The aggressive portfolio growing toward $63,000 takes about 8 years. Same contribution, same starting point. The only thing changing is the yield and the size of the target it has to reach. Now, in real life, people don't contribute the same amount into every strategy. Someone going conservative might also be able to save more per month. Someone going aggressive might be starting with less room in their budget. So if you adjust the contributions to $400, $300, and $250 respectively, the number shifts slightly to 22, 14, and 9 years. Both versions are useful. The first isolates the yield. The second reflects how people actually save. Just don't mistake either one for a prediction. They're models, not guarantees. But here's the twist, and it's the most important part of this video. None of those timelines are really about yield. They're about total return, and yield is not the same thing as total return. When a fund pays a distribution, its net asset value typically drops by roughly that amount. Reinvesting a distribution doesn't magically create extra return out of nowhere. What actually determines how big your account gets is the fund's total return after expenses. Price change plus distributions combined, not the yield number alone. SCHD's yield is 3.3%, but its actual portfolio can also appreciate or decline in value. JEPI's distribution is 8%, but that doesn't mean your account grows 8% a year. Covered call funds like JEPI and JEPQ specifically can lag during strong bull markets because part of their upside is exchanged for options income upfront. A high payout landing in your account every month does not, by itself, prove the underlying portfolio is growing. Track total return and NAV over time, not just whether the deposit hit your account. There's also a strategy this video hasn't mentioned yet, and it might be the most efficient one. Accumulation first, income later. If you're young and have 10 or 20 years before you actually need the cash flow, you don't have to hold an income fund from day one. You could build with a broad total return focused fund, let it compound without giving up upside to options premiums, and only rotate into SCHD, JEPI, or JEPQ once the account is large enough to matter. For a long-time horizon, that can outperform chasing yield from the very first dollar. The fastest way to $500 a month in dividends might not start as a dividend portfolio at all. Two more things before you build any of this. First, these are future dollars, not today's dollars. $500 9 years from now, 14 years from now, 22 years from now will not buy what $500 buys today. Inflation quietly shrinks the target while you're chasing it, so treat 500 as a moving number, not a fixed one. Second, every figure in this video is before taxes. What you actually keep depends on your account type and where you live. A taxable brokerage account, a Roth IRA, and a traditional IRA all treat this income differently. This isn't tax advice, just a reminder to check before you assume the full amount is yours. So, which path would I pick? Honestly, it depends on your timeline and your stomach for watching the account value move. The balanced portfolio is fast enough to feel real without leaning entirely on options income holding up through every market cycle between now and then. The aggressive path gets you there years sooner, if you can tolerate more volatility and don't need the money soon. The conservative path is slower, but it's the one built for someone who'd rather wait than watch their statement swing. None of these is universally correct. The only wrong answer is picking the one you'll abandon the first time the market gets rough. Pick one based on how much volatility you can actually live with, not how fast you wish it would go. Open the account, set up automatic reinvestment, and set a recurring deposit, even $50, even $100, because the monthly contribution is doing more work in these numbers than the yield is. Then come back in a year and check your progress against your own timeline, not someone else's screenshot. This is the first video in a series. I've already broken down what a $50,000 dividend portfolio pays every month and what a $100,000 portfolio looks like in full. This is where that story starts. Subscribe, because the next video picks up exactly where this one ends. The moment your portfolio crosses $50,000 and what changes once it does.